Before we begin, please be advised that trading foreign exchange and financial products involves a high level of risk. This content is strictly for educational purposes and does not constitute financial advice. You are solely responsible for your own investment decisions. We begin our technical analysis by looking at the BTC/USD pair on the daily chart. Our priority is to define the macro context before the New York session. We see a significant correction after the $97,000 highs. The upper PDH levels now act as pending liquidity, while price aggressively pushes toward the PDL. This bearish expansion suggests that institutions are seeking discount zones before the next major directional move. Refining our analysis on the 12-hour timeframe reveals a much more detailed market structure. The most striking feature is the massive fair value gap, or FVG, highlighted in purple. This price inefficiency acts as a magnetic pull for future sessions. Notice how the price has dropped sharply, leaving this unmitigated liquidity gap between $84,000 and $88,000. Before considering any entries in New York, we must observe whether the price respects the current PDL or decides to partially fill this inefficiency to balance supply and demand. Dropping down to the 8-hour timeframe, we can observe the strength of the recent bearish momentum with greater precision. Price is currently trading just below the lower boundary of the 12-hour fair value gap, creating a high sensitivity zone. It is vital to monitor how the asset reacts while trapped between this gap and the PDL support level. If the market fails to regain balance within the shaded range, we could witness an extended continuation toward lower liquidity levels before the New York Open. Moving into the 4-hour timeframe, the structure reveals a decisive institutional element, a bearish order block highlighted in ochre. This order block aligns almost perfectly with the lower boundary of our 12-hour fair value gap, creating a high probability confluence zone. We notice that the price reacted violently to the downside after testing this area, breaking the PDL with a high intent candle. For the New York session, this order block will serve as our primary resistance barrier. As long as the price remains below this level, the market narrative stays strictly bearish. Moving into the 1-hour timeframe, the liquidity landscape becomes much clearer and more concerning for bulls. Below the current price, we identify a formation of equal lows near the $82,000 mark. In institutional trading, these levels act as a magnet, representing a massive accumulation of sell-stop orders. Notice how the price is consolidating just below the 4-hour order block and the PDL. This action suggests the market is building energy for one final sweep toward those equal lows and the lower low daily, aiming to flush out retail buyers before any potential reaction during the New York session. Finally, we drop down to the 15-minute timeframe to pinpoint our entry zone. We have plotted a Fibonacci retracement from the high of the last impulse to the recent daily low. Notice how the price is seeking equilibrium levels, approaching the 0.618 and 0.786 area. These levels align perfectly with the 4-hour order block and the base of the 12-hour fair value gap. This technical confluence marks an ideal premium zone. If the price shows rejection at this point during the New York Open, we would have the perfect confirmation to seek a bearish continuation toward the equal lows. Arriving at the 5-minute timeframe, we enter the execution phase. Look closely at how the price has made a retracement move to the upside, testing the PDL level and the base of the 4-hour order block with surgical precision. This zone, which previously served as support, is now acting as solid technical resistance. The formation of upper wicks on recent candles indicates that sellers are defending this level, rejecting attempts at a bullish recovery. For an intraday trader, this behavior is the confirmation signal we were looking for. The market is validating the supply zone before targeting the lower liquidity objectives we marked earlier. Moving into the 3-minute timeframe, we achieve absolute precision. Notice how we have identified a new bearish order block, highlighted in purple, situated just above the PDL. The price has performed a perfect test of this zone and reacted immediately with a rejection candle. This formation is key, as it confirms that short-term order flow aligns with our macro bearish narrative. With the 3-minute order block as immediate resistance and the 4-hour block as higher-level backing, we establish a high-probability trading framework. We are looking at the final setup before targeting the liquidity objectives at the session lows. Positioned on the 1-minute timeframe, we proceed to execute a buy order, or long. After observing the previous liquidity sweep, the price has generated a 1M order block that we will use as the foundation for our entry. I have set up the position looking for an immediate bullish bounce, placing the stop loss below the structural low to protect our capital. Our take profit target is projected toward the upper equilibrium zones and the PDL that previously acted as support. This setup aims to capitalize on a short-term reversal, taking advantage of the fact that price is in a high demand zone after a prolonged drop, anticipating a positive expansion toward the previous resistance levels. We maintain our focus on the 1-minute time frame, where the long position is already active from the 1M order block. A fundamental technical detail in this screen is the identification of the lower highs marked on the chart. These levels represent the immediate resistance that price must break to confirm a local change of character. Notice how the price is reacting positively, reaching for the liquidity residing in the 3M order block located higher up. Our thesis remains solid: if the market manages to invalidate these descending highs, we will see a rapid expansion toward our primary take profit target before the opening volatility subsides. We continue monitoring the trade on the 1-minute chart and notice that the price has successfully reached the 3M order block. Due to the high probability that this resistance zone will displace the price against our position, I have decided to perform aggressive risk management by moving the stop loss into positive territory. Securing profits is vital when the asset interacts with supply zones from higher timeframes. Notice how the previous lower highs are now acting as local support levels. We are protecting the trade against a potential reversal, while maintaining the expectation that if the bullish momentum persists, we can aim for even more ambitious exit levels. We are closely monitoring how the price on the 1-minute timeframe reaches the exact center of the 3M order block. In institutional trading, the midpoint of an order block is a highly sensitive zone where the probability of a pivot or reversal increases dramatically. Given this scenario, it is essential to maintain close watch over the price action. If the asset fails to break through this central level with momentum, we could see an imminent rejection. Therefore, our risk management must be impeccable at this point, as we are interacting with a supply zone that has the potential to displace the price against our current position. In this crucial phase of the trade, we observe that the price has penetrated deeply into the 3M order block, surpassing previous local highs. Because the asset now in an extremely sensitive supply zone, I have decided to trail the stop loss well above the entry point to secure actual profits. This management is mandatory for a professional trader. Once the price hits a higher timeframe technical objective, we cannot allow a winning position to turn into a loss. By protecting the trade, we eliminate emotional risk and position ourselves to see if the market has enough strength to seek a larger expansion or if, conversely, it begins the expected reversal. Notice how the price finally reaches our primary take profit target, located at the upper boundary of the 3M order block. It is fascinating to see the precision with which the market fills the inefficiency and reacts to the liquidity of the previous lower highs we marked earlier. Having completed the expected displacement, we proceed to close the position to crystallize the session's profits. This trade demonstrates the importance of patience. We entered on a 1-minute block following a liquidity sweep and exited in an institutional supply zone, securing an excellent risk-to-reward ratio before any potential reversal occurs. Watch closely during this moment of high market tension. By just a few ticks, the price has failed to reach our exact exit level. In professional trading, these situations test our discipline and psychology. The asset has interacted with the top of the 3M order block, but the remaining liquidity has prevented the order from being fully filled. Despite how close it is, we stay calm and avoid closing manually out of desperation. Our risk management is already secured with the stop loss in profit, so we simply observe if the next impulse has enough strength to clear those last contracts and close the position with total success. After that moment of uncertainty where the target was missed by just a few ticks, notice the appearance of this key rejection candle, marked by the blue arrow. The market has found a dynamic support zone just before our exit level, injecting the necessary bullish pressure to regain momentum. This reaction is a powerful technical signal. It tells us that demand remains active and that price clearly intends to finally break through the 3M order block. Instead of giving in to doubt, we trust our reading of the order flow. This new microstructure suggests that the final displacement is about to happen, validating our patience as price moves decisively toward the liquidation of our position. Finally, the price hits our protection level, confirming that the 3M order block has acted as a powerful reversal catalyst. This reaction provides us with valuable information. The market lacked the strength to overcome the supply zone and, instead, performed a liquidity sweep. Given this scenario, we immediately shift our bias. The inability to sustain the highs and the violent rejection at the upper block indicated is time to position ourselves in a short. We will capitalize on this downward displacement, expecting price to return to lower support levels, now aligning ourselves with the selling pressure that has just aggressively entered the session. As we move back up to the 3-minute time frame, the landscape shifts dramatically, offering a clear opportunity to go short. Notice how price has validated the 3M order block as an insurmountable resistance, leaving behind a trail of rejection that confirms buyer exhaustion. I have decided to execute a short position, taking advantage of the market just sweeping the upper liquidity and now seeking to balance the price downwards. We place our stop loss above the institutional block and project our target toward the lower support levels. We are trading in favor of the new order flow, trusting that the rejection in this supply zone will catalyze a smooth bearish displacement throughout the rest of the session. By closely observing what is happening on the 3-minute time frame, we detect a highly relevant technical signal for our short position. The candle preceding the current one shows a massive rejection of buying pressure, leaving an upper wick that confirms supply is winning the battle at these levels. This price action tells us that, despite recovery attempts, the market is refusing to continue higher, validating the strength of the 3M order block as our primary barrier. This visual confirmation reinforces our bearish thesis, providing the necessary confidence to keep the trade open as we wait for the order flow to finally displace the price toward our lower liquidity target. We now drop down to the 1-minute time frame to observe the detailed anatomy of the current move. Following our short entry, price begins to carve out a clear structure of bearish impulses and retracements. Notice how every recovery attempt is quickly neutralized by supply, creating consistently lower highs. This sequence of impulses confirms that short-term market sentiment is fully aligned with our macro thesis. By breaking down the price action this way, we can identify that selling pressure remains in control, moving the asset healthily toward our targets while volume supports each new expansion leg to the downside. Observing the candle prior to the current one on the 1-minute chart, we detect a bearish engulfing candle of great technical significance. My primary objective right now is to monitor whether price manages to close solidly below the higher lows we previously marked. If the candle body breaks this structure, we would be looking at a clear confirmation of a liquidity sweep. This scenario would invalidate any residual buying pressure and give the green light for the bearish displacement to accelerate. We are looking for institutional order flow to take definitive control, flushing out retail buyers before moving decisively toward our profit target at the bottom of the range. Observing the current dynamics on the 1-minute chart, it is evident that price maintains strong bearish momentum. The volume of recent candles and the decisiveness with which they break local structures confirm that selling pressure is dominant. Given this clear display of institutional strength, I have decided to trail the stop loss again to protect the trade and lock in more profits. This active management allows us to reduce risk exposure while letting the trend unfold. Notice how the asset ignores previous demand levels, reinforcing our thesis that the market is seeking much deeper liquidity targets during this session. We are conducting a strict follow-up on the price action to visualize the development of our thesis. Notice how the asset continues its downward displacement, moving decisively toward the support levels we identified on higher timeframes. The market structure on the 1-minute chart validates our position, showing that any bounce attempts lack sufficient buying volume. It is crucial to maintain discipline at this point, observing how price interacts with each internal liquidity zone. This constant vigilance allows us to confirm that the order flow remains under selling control, providing the necessary peace of mind to let the trade run toward our final take-profit target. Analyzing the current price action on the 1-minute chart, we identify the formation of a new fair value gap. It is important to note that even though the displacement is occurring with low-volume candles, the creation of this inefficiency serves as confirmation of bearish intent. In institutional trading, these gaps often act as the engine driving price toward deeper liquidity zones. I maintain a high probability of hitting our take profit as the structure continues to respect lower highs. The lack of buying volume suggests there is no interest in reversing the trend, allowing the market to drift organically toward our final target at the bottom of the range. At this point in the trade, I have decided to trail the stop loss just above the 1-minute fair value gap to lock in profits. This decision is based on the logic that the FVG should act as solid resistance in a healthy bearish trend. If the price fails to respect this inefficiency and closes above it, the short-term narrative would have shifted, and the most prudent move would be to exit with our protected gains. By making this adjustment, we eliminate any risk of loss and allow the trade to continue developing toward the final target, trusting that selling pressure will keep the price below this new level of technical control. We are in the final stretch of the trade, with the price hovering extremely close to our take-profit target. However, in professional trading, proximity does not guarantee success. Until the order is filled, the risk of a sudden reversal remains. Notice how the asset struggles to break through the final liquidity levels just before the take-profit. Despite the strong bearish momentum, we maintain discipline and absolute vigilance. There is no room for complacency. Our stop-loss is already protecting profits above the fair value gap, allowing us to calmly observe whether the market completes the final displacement or, conversely, offers an unexpected reversal signal. Finally, patience pays off, and the price hits our profit target with total precision. With this trade closed, we conclude today's analysis, demonstrating how institutional reading and risk management are the keys to success. If this content provided value to you, I invite you to subscribe to the channel, hit the like button, and share this video so our trading community can keep growing. I have much more strategic content to share with you. Don't forget to leave your questions in the comments, as I always respond personally. Thank you for joining me, and I'll see you in the next session.